Today, we're diving into a really groundbreaking proposal for how to manage one of the biggest, scariest new risks in our economy: fully autonomous AI running loose in the world of finance. All right, let's get into it.
You know, this isn't science fiction anymore. We're talking about agentic AI. AI that can actually do things on its own to hit its goals. And it's already here, operating in some of the highest stakes environments you can imagine. These systems are building portfolios, they're executing trades, they're deciding who gets a loan, all with very little human supervision.
And that, right there, is the terrifying central question. If every single bank, every insurance company, every asset manager is using a similar kind of AI, all trained on pretty much the same data, what's to stop one tiny, hidden flaw from causing a catastrophic, market-wide failure? That's the core problem we're talking about: correlated failure.
And the scope here is just massive. I mean, think about it. These AI agents are being woven into the absolute fabric of our financial system. We're talking about everything from how your pension fund is managed to the way your car insurance is priced. The potential for a single point of failure to go wrong, well, it affects absolutely everyone.
So let's actually put a name to this threat. The paper we're looking at calls it AI monoculture, and it's a perfect analogy. It's like the financial version of planting only one type of corn across an entire country. Sure, it's super efficient, but it's also dangerously fragile.
And you have to understand, this isn't just about everyone using the exact same piece of code. It's much subtler than that. It's about having the same dependencies, the same big cloud vendors, the same foundation models, the same market data feeds. All this creates this kind of invisible herd mentality, where all the AIs start to think alike without anyone even planning for it.
And this, right here, shows you the mathematical nightmare. With a bunch of different diverse AIs, your risk of failure basically just adds up. If you have n AIs, your risk scales with n. Simple. But in a monoculture, oh no. The risk doesn't add, it multiplies. The failures all become linked, and your total potential loss suddenly scales with n squared. That is a massive, exponential jump in system-wide risk.
So what does that lead to? It leads to this terrifying thing called a phase transition. The system looks totally fine, totally stable, it's handling all the little shocks, business as usual, right up until the second it isn't. One event crosses some hidden line, and the whole system just tips over into a cascade of failures with absolutely zero warning.
So, how on earth do you see that coming? Well, the paper proposes this really clever metric, the spectral radius, that basically acts like a fever thermometer for the whole system. It measures how a single tiny shock would get amplified as it bounces around this network of connected AIs. And when that number starts to creep above 0.85, that's your critical early warning. It's telling you the system is getting way too fragile and is ripe for a cascade.
So, and this is the really clever part of the proposed solution, it's not about trying to predict every single possible failure. That's impossible. It's about what they call geometric safety. Think about how Switzerland deals with e-scooters. They don't try to predict every accident. Instead, they just cap the maximum speed. That way, they know that when an accident does happen, the energy, and therefore the harm, is limited. This is that exact same logic, just applied to global finance.
Okay, so we've laid out the threat pretty clearly. Now let's talk about the solution. The paper proposes this really comprehensive safety net. It's called the Finance-Grade Verifiable Governance Architecture, or FG-VGA for short.
And I want to be clear, finance grade is not just some marketing buzzword. It's a very specific objective. It means taking the chaotic uncertainty of an AI and wrestling it into something that is controlled, that produces a clear evidence trail, and that a board of directors can actually be held accountable for.
So how does it work? Well, it's all about layers. First, you set the rules of the road, but you write them as computer code. Second, every single action the AI takes creates a little digital evidence packet that you can audit. Third, you use cryptography to prove that the code that's running is actually the code that got approved. And finally, fourth, you are constantly monitoring the whole system for those dangerous coupling signals we just talked about.
Okay, now let's zoom in on what I think is the most brilliant and innovative part of this whole framework. How do you actually measure and enforce that AI diversity to stop the monoculture from ever forming?
The answer is a brand new metric they call the Heterogeneity Score, or HS. It's a single composite number designed to do one thing: tell you exactly how different two AI models truly are from each other.
And this score is smart. It doesn't just look at whether the AIs give different answers. It looks deeper. It asks, is their internal logic, their reasoning, actually different? And maybe most importantly, do they react differently when things get crazy, when the market is under stress? It's really designed to measure diversity in thought, not just diversity in action.
And this is where the rubber really meets the road. That score isn't just a number on a dashboard, it's directly wired into real-world consequences. If your AI models start looking too similar, if that heterogeneity score drops too low, it's not just a warning light. It automatically triggers a mandatory review by humans, and it forces your firm to hold more capital in reserve as a safety buffer. And if it gets dangerously low, the system is forbidden from running, period.
So what you realize is, this whole system does more than just stop bad things from happening. By creating real financial incentives for diversity, it basically creates the blueprint for an entirely new market. This is a market for tools, for services, and for human talent, all built around creating and proving that an AI can be trusted. Let's look at how that actually builds out.
And look, this isn't just some academic theory. It's a practical business plan. The paper lays out real cost estimates and timelines. We're talking about almost $1 million per firm just to build these initial systems. Now multiply that by every bank, insurer, and hedge fund in the world, and you are looking at a massive, multi-billion-dollar market for AI governance technology. And the rollout plan is totally practical. It's a phased 2-year journey. This tells you it's not a simple software install that's one and done. No, this is about creating an entirely new corporate function inside these financial firms, a function that needs constant work, ongoing calibration, and optimization. And that means long-term projects and a sustained demand for a whole new kind of expertise.
And that right there brings us to the most direct impact on careers. To build this, to run this, you are going to need a whole new breed of professional in finance. We're talking about people who can audit an AI's mind, people who can write financial policy as code, people who can design clever tests to try and trick the AIs and find their flaws. These are going to be the high-demand, high-paying jobs of the next decade in finance, for sure.
So, we'll end with this question. This framework gives us a pretty good technical answer, but it opens up a much, much bigger societal one. As we hand over more and more control of our economy to these autonomous agents, the job of being the auditor of their collective mind, well, that might just become one of the most important jobs in our entire society.